Most people believe they are investing correctly simply because they are putting money into something. That the truth is harsh. Many common investing behaviors quietly keep people poor. These mistakes do not look dangerous at first. They feel normal, even logical, but over time, they destroy growth and prevent wealth from building. If you continue investing this way, your results will stay limited no matter how much you earn. One of the biggest mistakes is investing without a clear plan. Many people buy assets randomly, based on news, advice, or trends. Without structure, decisions become emotional and inconsistent. A clear plan defines how much to invest, where to invest, and how to stay consistent over time. Another problem is chasing quick profits. Many investors jump into opportunities that promise fast returns. These situations often come with high risk. Instead of building stable growth, they create volatility and losses that slow long-term progress. Trying to time the market is another major mistake. Waiting for the perfect moment often leads to missed opportunities. Markets move unpredictably, and hesitation results in lost time. Being consistently invested is far more effective than trying to predict short-term movements. Emotional investing keeps people poor. Fear during market declines leads to selling at losses, while excitement during rallies leads to buying at high prices. This cycle repeats, preventing long-term growth and destroying potential wealth. Another issue is inconsistency. Investing only when it feels comfortable or convenient breaks the compounding process. Wealth is built through regular, disciplined contributions over time, not occasional action. Another mistake is ignoring diversification. Putting all your money into one asset may seem like a faster way to grow, but it increases risk dramatically. If that single investment performs poorly, your entire portfolio suffers. Diversification spreads risk across different assets, creating more stable growth and protecting your capital from unexpected losses. Many investors also trade too frequently. They believe that constant activity leads to better results. In reality, frequent buying and selling increases costs and leads to poor timing decisions. Each trade reduces overall returns. Long-term investors who hold quality assets often outperform those who try to stay active in the market. Another hidden problem is ignoring fees. Investment costs may appear small, but over time they reduce your total return significantly. Management fees, commissions, and hidden charges quietly eat into profits. Choosing low-cost options allows more money to stay invested and grow through compounding. Failing to reinvest profits is another behavior that limits growth. Dividends, interest, and gains should be returned to investments to maximize compounding. Spending them interrupts the growth process and reduces long-term results. Another mistake is waiting too long to start. Many people believe they need more money or better conditions before investing. This delay costs time, which is the most valuable factor in building wealth. Starting early, even with small amounts, creates a significant advantage. Lifestyle inflation also keeps people poor. As income increases, spending increases as well. Instead of investing more, people upgrade their lifestyle. This prevents wealth accumulation and keeps financial progress slow. Another issue is lack of patience. Many investors expect quick results and become discouraged when progress feels slow. They change strategies too often, never allowing compounding to work. Real wealth takes time to develop. Emotional reactions to news often lead to poor decisions. Headlines create urgency and fear, pushing investors to act impulsively. Staying focused on a long-term plan is more effective than reacting to short-term information. Another mistake is not increasing investments over time. As income grows, contributions should grow as well. Keeping investments the same while spending more slows financial progress. Avoiding risk completely can also limit growth. Keeping money in low-return assets may feel safe, but it prevents wealth from building. Balanced risk is necessary for long-term success. Comparing yourself to others leads to poor decisions. Seeing others succeed quickly creates pressure to take risks. Staying focused on your own strategy is more effective. Overcomplicating investing strategies often leads to mistakes. Simple, consistent plans are easier to follow and usually produce better results. Another mistake that keeps people poor is focusing only on short-term results. Many investors check their portfolios daily and react to every small movement. This creates stress and leads to unnecessary decisions. Short-term volatility is normal, but reacting to it breaks long-term strategies. Wealth is built over years, not days. Those who focus only on short-term outcomes often make changes that reduce their overall growth. and prevent compounding from working effectively. Another problem is not having a clear financial goal. Without a defined purpose, investing becomes random and inconsistent. People invest without direction, which leads to poor decisions and lack of discipline. A clear goal provides motivation and helps maintain consistency during difficult periods. It also makes it easier to measure progress and stay focused on long-term success, instead of reacting to temporary changes in the market. Many people underestimate the importance of starting early. They believe they can invest later and still achieve the same results. However, time is the most powerful factor in investing. Starting early allows compounding to work for a longer period. Delaying even a few years can significantly reduce final outcomes. Those who start late must invest much more to reach the same level, making the process more difficult and less efficient over time. Another issue is focusing too much on earning and not enough on investing. While increasing income is important, it does not automatically create wealth. If money is not invested, it will not grow. Many people earn more but spend more, staying in the same financial position. Investing transforms income into assets that generate future value, which is essential for long-term financial independence and security. Emotional reactions during market downturns often cause major losses. When prices fall, fear pushes investors to sell in order to avoid further losses. However, selling during declines locks in losses and prevents recovery. Markets historically recover over time, but only those who remain invested benefit from that growth. Staying calm and following a plan is essential for long-term success. Another costly mistake is frequent strategy changes. Investors jump from one approach to another, chasing better results. Each change resets progress and prevents compounding from building momentum. Consistency in strategy is essential for long-term growth. Without it, even good investments fail to deliver meaningful results. Ignoring inflation quietly reduces wealth. Even if money appears stable, its purchasing power decreases over time. If investments do not outpace inflation, real value is lost. Many people focus only on nominal returns and ignore this effect. Understanding inflation is critical for protecting and growing wealth. Another behavior that keeps people poor is relying on luck instead of discipline. Some expect one successful investment to change everything. While occasional gains may happen, sustainable wealth requires consistent effort and planning. Discipline produces reliable results over time, while luck is unpredictable. Stopping investments during downturns is a major mistake. When markets decline, many investors pause contributions or withdraw money. However, lower prices often provide better opportunities for long-term growth. Continuing to invest during these periods strengthens results and improves future returns. Another problem is not reviewing investments periodically. Without review, portfolios can become unbalanced or misaligned with goals. Small adjustments help maintain stability and manage risk. Ignoring this process can lead to unnecessary exposure and reduced performance over time. Failing to build strong financial habits limits growth. Investing should become a routine, not a decision made occasionally. Habits create consistency, and consistency builds wealth. Without strong habits, progress becomes irregular and unreliable. Finally, lack of patience prevents success. Many investors quit before seeing real results. Early stages of investing often feel slow, but over time growth accelerates. Those who stay consistent benefit the most, while those who quit remain stuck. Another major issue is not automating your investments. When investing depends on memory or mood, it becomes inconsistent. Some months you invest, others you skip. Automation removes this problem by creating a steady flow of contributions. This builds discipline without effort and ensures that your strategy continues, even when motivation is low or life becomes busy. Many people also waste unexpected income. Bonuses, gifts, or extra earnings are often spent quickly instead of being invested. This is a missed opportunity. Investing additional income accelerates growth and strengthens compounding. Over time, these extra contributions can make a significant difference in total wealth. Lack of long-term planning keeps people stuck. Without a clear direction, decisions become reactive instead of strategic. Investors move from one idea to another, never building a stable foundation. Long-term planning helps align actions with goals and improves consistency. Another mistake is constantly changing strategies. Each time you switch your approach, you reset your progress. Compounding requires stability and time. Investors who keep changing plans never allow any strategy to fully develop. which prevents meaningful growth. Focusing too much on short-term performance creates stress and poor decisions. Daily price movements are unpredictable and often irrelevant. Reacting to them leads to unnecessary changes that reduce long-term returns. Lack of discipline is one of the biggest reasons people stay poor. Even the best strategy fails without consistent execution. Discipline ensures that investing continues regardless of emotions or market conditions. Not understanding compounding limits growth. Compounding allows returns to generate more returns, but it takes time. Those who quit early never experience its full power. Staying consistent allows this effect to grow. Ignoring small habits reduces long-term success. Small actions, repeated regularly, create powerful results. Saving and investing consistently builds a strong financial foundation. Seeking shortcuts often leads to losses. Quick gains are attractive, but they come with high risk. Sustainable wealth is built slowly through disciplined investing. Quitting too early stops progress completely. Many investors give up before results become visible. Persistence is what allows growth to accelerate. Not adapting gradually can cause instability. While consistency is important, small adjustments help maintain balance as life changes. Ignoring this reduces effectiveness. Expecting fast results leads to disappointment. Investing is a long-term process. Those who expect immediate success often quit too soon. Comparing yourself to others creates pressure. Every investor has a different path. Staying focused on your own plan leads to better results. Fear of making mistakes prevents action. Waiting for perfect conditions leads to lost time and missed opportunities. Overreacting to market changes leads to poor decisions. Staying calm and consistent protects long-term growth. Not increasing investments over time slows progress. As income grows, contributions should grow as well. The real difference is behavior. Discipline and consistency build wealth, while emotional decisions destroy it. If you keep investing like this without discipline, patience, and consistency, you will stay poor. Change your behavior, and your results will change.